Hey folks, it's Dave Burrows. I am a CIO and CEO here at Barometer Capital Management, and I want to welcome you all to our weekly webcast. I've asked Diana Avigdor to join us today. Diana is our head of trading. So whereas I look at the ground from 30,000 feet, she looks at it from ground level. And spends her day in, I don't know, 21 or 22 different chat rooms with different investment dealers and talking to trading desks and giving us kind of daily color. And so I thought it might be useful given the excitement we had over the last few days in global markets. As always, I want to kind of take a top-down view of the world and take a look and see what has changed, what's staying the same, how that impacts, our portfolio structures, what actions we're taking in the goal of being completely transparent and helping people understand how we make our decisions. So welcome, Diana.
Thank you
Uh,
very much.
just sort of really from a high level view, I think, people who have been on these webcasts before recognize that, from a big picture view, we think we're in a secular bull market in equities that started in the US in 2013 and continues today. If we look at the last two secular bull markets, the 80s and 90s, this is the S&P, or 2013 to present. Common characteristic is that basically the market stayed above the rising 200-week moving average through the entire piece, that there were periodic corrections slash cyclical bear markets, some of them coming in time, some of them coming in price, and a combination of the two. And that in between cyclical bear markets, we tend to have relatively low volatility, long periods, 2 to 3 years, where you can take sort of 4 steps forward for the 1 step back that you've taken in the cyclical bear market. So our most recent cyclical bear market ran from December of 2021 through January of 2024. So that's 25 months. And in January made new highs. So we've been working our way higher since then. From the beginning of 2013, the S&P is up about 260% over 137 months. To put that in context, it's a little over half the length of the bull market in the 80s and 90s, 220 months, 1,300% return during that period. So it may well be that we are still relatively early stage or sort of middle innings. Our view is that we're now 6 months through into the next cyclical bull market in the bigger context, and that we're going to have 5%, some 10% corrections along the way. And in the month of August, as we sit, as of just before the close, we're down about 4.5% in the month of August. So, some conflicting thoughts. Often we see some bumpiness in August and September. In re-election years, you don't tend to have a lot of it. And we're going to talk a little bit today because over the last 2 weeks, the S&P pulled back in its channel and broke below the channel. We talked about this last week, driven by some of the bigger companies in the market. At the worst point yesterday, S&P was down about 9.6%, trading above the 200-day moving average, but down through the 8, the 21, and the 50-day moving average. We left a couple of gaps behind on the chart, very gappy action, very sharp decline. So we want to talk to Diana a little bit about that. To put it in context, we've talked over the last 6 months about the fact that U.S. stocks have had really historic outperformance versus the rest of the world. This is why we started our global fund in December of this past year, because we think that there is opportunity there from a risk-reward perspective. I think most people know we have been actively taking down our exposure in the very largest companies. We put this slide up a few weeks ago, where about a month ago, 2 months ago, the top 5 stocks made up 29% of the S&P, which historically is a really big percentage. And that, until partway through May, the number of stocks beating the index was historically low. at about 25% of stocks beating the index. So that's set up, an interesting situation. Now, in the last couple of weeks, we talked about the fact that after a long period of underperformance, the average stock, and especially small and mid-cap stocks, really blasted off. On July the 11th, we had a low CPI number, which pointed to getting toward target for the Fed. We had a couple of weaker data points that highlighted that likely we would get a September rate cut. And that positively impacts smaller and mid-sized companies because they tend to have a little bit more debt. They tend to have less access to capital. And our view is that's the market looking out toward the next, business cycle. Now, in the last, we also talked about the fact that we had this throwover in the NASDAQ 100. So where we ramped up beyond the trend line, which is often a sign of exhaustion, and that we had a big weekly reversal in direction once it did that. So we came down through that channel. We talked about being a little bit less positioned in these types of stocks. And then, of course, in the last couple of days, boy, they really got hit. So as of yesterday morning, I think we opened NASDAQ 100 down about 16% off the highs. We rallied a little yesterday. We rallied a little bit more today. But, that big breakout in small caps was accompanied by very big volume. And in fact, we started to see real flows into the non-tech sectors over the last couple of months. We also have talked a little bit about the US dollar. Now, the US dollar tends to be a place that people go to when they're looking for safety. When we went through the 2022 bear market, a lot of money to the US dollars. And the US dollar made a high versus the pound and the euro and the yen in October of 22, which was when the market made its lows. The US dollar backed off when we made a low in March of 23. The dollar had a little bounce. When we made the low in October of last year, dollar had a bounce. We made the lows in April. I think the market pulled back 5% in April. We had a local high. But we broke this trend over the last few weeks. So the tendency to look at that would say, well, it tends to be that that's people willing to take risk, and that's when we saw the small caps take off. It tends to be that commodities start to do relatively better when you got a weaker dollar. It tends to be that global stocks, ex-North America, tend to do a little bit better. We're seeing that. But this past week, if you look at the yen versus the US dollar, after an exceedingly weak period that actually has been going on for a very long time on the long-term charts, the Japanese central bank raised rates for the first time. And keep in mind that rates have been close to zero, for over a decade. And so as European investors go, they've had to find solutions as to where to get a return. And this sharp move in the yen really kicked off a bunch of global volatility. So I've asked Diana to come on just to talk a little bit about why that may have driven volatility, what it may mean going forward. This is what it meant in the Nikkei, a very sharp sell-off, 2 bad down days. Yesterday, down 12%. Interestingly enough, up 10 today. But Diana, maybe you could talk a little bit about that.
Sure. So what happened in the Nikkei? 12.5% on Sunday night, and then it was up 10.5% last night. The 12.5% was Black Monday for Japan. Hasn't been seen since 1987. So let's back up a little bit. Foreign exchange investors have been enjoying a quiet, rich life. Predictable monetary policies have made it easy to borrow yen at zero rates. And like you said, seeking return elsewhere, invested in US dollar assets in those other countries where interest rates are high. The Mexican pesos is one of those. But in the US, they bought dollars and then they invested in the stock market. They invested in anything that was momentum based and made the money. So for example, in particular, investing in the Mag 7 has been very popular. And as the yen carry trade is being unwound due to the Bank of Japan raising rates, all other assets needed to be sold to meet margin calls, among other things. And where were they able to get liquidity? Well, first and foremost, they were able to only get liquidity in their local market because it was middle of the night. So that created a little accident on the Nikkei, and right on the open was down limit. But then you ask yourself, well, why do we care? That's them, not us. But they were invested in momentum and growthy stocks in our local markets, North American in particular, less so in Canada. And so you started seeing, and we're coming at the back of this rotation that you've been talking about. So the cyclical versus defensive ratio had the worst day since COVID. They sold everything they owned as they repatriated the yen back. And important to note that even though there was some volatility, major volatility, when you think about it, when you repatriate yen into Japan, that's going to have to be put to work. And we've seen a rally of over 10% the next day, which is almost silly in volatility. But some people were able to take advantage of the situation. For example, we saw Warren Buffett yesterday um, take out a bond and invest in Japanese assets at this time, because if you're not going to invest globally, Japan was the largest exporter of capital. But if that's going to come to an end because the Bank of Japan has stopped being at zero rate environment, the local market and the local stocks are likely going to be bid up.
Interesting.
So this, so this chart that you're showing is showing liquidity in the market. This comes at a seasonal period of August, tends to be very low liquidity. And the volatility, especially that we're coming in from this rotation where growth already started losing a bit of momentum, and the small and mid caps started acting better because, of the prospect of less restriction, less monetary restriction, lower rates, which help the small and mid caps, which are more indebted. So that rotation already started. Plus August, market makers are pulling away from making big markets. We call it at the touch, but all it means is the ability of how much money are you able to move at a touch, hitting the bid or taking an offer. And that liquidity, that depth of book is very, very low, as you can see in that chart. In addition, we call this dealer gamma, but in simplicity, what it means is the option market has really gotten to be very, very attractive in the market in the last 10 years, especially since COVID. So that creates exposure on the dealer side. Whatever gamma is, it's their exposure, it's their ability to support the market. And when it's this low, there was no dealer support. So you have volatility with low liquidity at the touch and no interest on the dealer side to support, or no need to buy anything. So that takes away another pool of liquidity. So you have more volatility. In addition, you have three pools of money, really. You have the systematic, the macro strategies. Think of those as the trading community. They are quantitative, they're rule-based, mathematical, they're short-term, and they impact price. There is the retail, and then there's the institutional. In this chart, what you're seeing is that the systematic macro strategies, that the trading community is pretty highly invested, and they have stuff to sell. It's already gotten taken off. Over the last couple of days, there was about $50 billion that went through the market. Just for context, during COVID, it was 500 billion. But the asset manager, the long-term, the pools, the pension funds, the slower money is still very highly invested. So they may or may not come to the market. I'm hearing that some exposure has started to be taken off. And so I think that this kind of volatility probably had a little bit of created a little bit of a crack in the teapot, and it's going to take a little while for all this money to flow through the market, be it because of having to take leverage off, margin calls, a little bit of lack of confidence, not fully done, have to do some more, wanting to dollar average. So I feel that there's going to be a little bit more. Retail also, which has been the big buyer in this market, and especially since COVID, have been pretty stable in their flows. They had to come off a bit. When stocks and portfolios go down, of course, the risk manager or the margin guy taps you on the shoulder and says, you need some money. So if you don't have money to put more into your account, you're going to have to sell your exposures. And the reason I say that this has more room to go a little bit is because when these systematic macro strategies are very calculatable. You more or less know what their assets under management are. You know their triggers, you know their mandates. So more or less you can calculate what they're going to do. And this chart shows you from Morgan Stanley Quantitative Desk, it shows you that there is risk for sale. We call it risk for sale. That's money for sale, stocks for sale, exposure for sale. No matter what happens to the market, whether it goes down, they're calculating it in the range of -5% or up 3%. So even on a day like today, where the market was up, there was still stock for sale. And I can tell you, I just watched the close just before we got on, and there was 7 billion for sale on market on close. Traders like to use market on close because it's bigger liquidity than during the day. I showed you there that the liquidity at the touch is pretty low. So the market on close is a big auction, and they're able to move some stuff.
So
So the
Diana,
close was pretty heavy.
from this chart, then this basically gives us an estimate. Now, remember, the systematic funds, which we're talking about here, are one piece of the market. And if the big long only mutual funds, pension funds, if they're not moving one way or another, these folks can have an impact. When the long only community is engaged and invested and wants to be invested, these don't mean so much. But at a moment when we get lower liquidity and a more volatile move, this gives us an idea of how much, for instance, the market goes down 3% from here, likely another 50 to 60 to 70 billion needs to be sold. And that's coming from this rules-based quantitative community. So it just gives us an idea as to what to watch for if we see more volatility, and we'll see. We did get a very significant spike in VIX, which brought on some of the selling. Now we'll see whether things calm down. On the other side, Diana, what could be an offset?
There are some offsets. The corporate buyback calendars is pretty big. Corporates are buying back. Well, they were in a quiet period during earnings season, and now they're all slowly coming back. So you see here a calendar with an estimate of what the corporate buyback estimate is, and you can see it's could be even as high as $50 billion in any given day. So this is an offset. It
Yeah.
might mute volatility a little bit.
So
So we're not thinking, I'm not calling for bear market or bad markets, but I'm just saying that given what's been going on, that there could be a period of a few weeks where market is likely going to be in a bit of a balancing act.
yeah, little bit of bounce around. Now we balance that on the other side by the fact that we have seen, the core inflation coming down, which gets us a lot closer to rate cuts. Certainly, when we look at the risk of recession, the market, after the most recent sort of slightly weaker economic data, has priced a little higher possibility of a recession. But when you see investment dealers posting a 30% possibility of a recession, they're really saying there's very little chance of a recession. They're never going to say zero. Goldman Sachs, in fact, is suggesting there's a 15% chance of recession, which is them basically saying there's no chance. We've seen the earnings come in and the earnings revisions. We talked about this past week. You know, the Q2 earnings revisions were much less negative than would typically be the case. And the earnings have come in, pretty strong. So these are all things that have an impact. Here are some things I'm looking at. Forget the market cap weighted S&P. Let's talk a little bit about the equally weighted S&P. When the Japanese came in as big sellers, you can imagine they are selling things that they have built up over many years, and in large part, the most crowded positions in the market. So where the S&P sold off 9%, as of just before getting on here, the equal weight S&P is down 3.6% off the high. I think that's a real positive factor. We broke out of this consolidation range, the upside. We pulled back. We briefly dipped below it, but we're already back above this most recent consolidation range. I think that's important. The average stock came through this last few days way better than the stocks everybody owns, like Microsoft and NVIDIA and so on. The history of 5% pullbacks during cyclical bull markets is, a month out. The median and average returns are, 2 to 3%. 3 months out, they're kind of 4 to 6%. 6 months out, they're 6 to 7%. I mean, these things happen. We get an average of 5% pullbacks a year, 10% per year. And basically, we've seen 10% top to bottom in the S&P. It probably has to bounce around a little bit and rebuild the charts. But we know, and we've talked about the fact that after you have years where the market cap weighted S&P leads, you often have years where the equal weight S&P leads. And that's important to us because we're never invested like the market cap weighted S&P. We're never going to have, 10 times as much Microsoft or 20 times as much Microsoft as we are, Owens Corning. When I look at the Nikkei, the big picture, okay, this is this most recent month. This was the big down. We've recouped a whole bunch of it. It really doesn't even leave a mark at this point. We were fortunate in our Japanese exposure. We went from currency hedged exposure a month ago. We switched it to unhedged currency exposure, meaning that a rising yen would help us. So our little bit of Japanese exposure, wasn't a big deal over the last couple of days because while the market dropped, the yen bounced, and we got a win there. We talked about the S&P TSX over the last couple of weeks and how it's broken out to new highs, and it got a little impacted. But we're above where we were last month. We're above this most recent consolidation range. We'll see what happens going forward, but it's hanging in pretty well. When we look at fixed income, it's interesting. We've followed the fact that we went from 1981 to 2020 in falling rates, and then we had a series of higher lows and higher highs. We talked last week about the fact that we have not made a new high in yields since we did 6 months ago. And we did pull back a little bit over the course of this week. In fact, we traded to a lower low. So that's interesting. It means that yields are coming down. It means that helps bond investors a little. It really helps investors who own rate sensitive securities. But nothing really changing there. When we look at stocks versus bonds, very clearly this rising moving average suggests that stocks have been a good place to be relative to bonds, and we remain above the moving averages. So we'll watch that closely. But, certainly stocks have pulled back a little relative to bonds, and that wouldn't be a shock. It's happened a number of times along the way. Commodities. Now, commodities pulled back a little over the course of the week. Commodities are pretty volatile asset class. I think it's interesting. I mean, as of just before I jumped on, they've pulled back 6% off the highs. Um, I think that's sort of surprising, to be honest, given the fact that they are a more volatile asset. If the concern is that, some of this weakness is driven by, weak economic data and concern about a recession, that's really not much of a pullback in the commodity prices. And when we look at it in the big picture, and we put this chart up before commodities versus equity ratio, we've only just recently made a turn in 2020 where commodities started to outperform. And you can see that here. So to have a tiny little dip doesn't make a difference in the base case for commodities. Certainly when we look at gold, we've talked about that over the last little while. It's down 3% from the highs. I think that's not something to be concerned about. We're above the lows from last month. We've been making a series of higher lows. So not a lot changed there. Really, I think the issue is that what was for sale were crowded assets, things that everybody's been focused in. Commodities were in a bear market for 10 years and only just started doing well. They're certainly not crowded. The only ones buying gold are central banks. So no change in the picture there. In fact, we put this up last week and it turned a little bit more favorable. I do think this is a shift, and we'd have thought there was a shift taking place in the types of things that can work. We know that, gold outperformed the NASDAQ from just around 2000 through 2011. And then underperformed while the NASDAQ's been running like crazy since then. We do think there's a shift taking place there, which is why we're underweight NASDAQ. But this sort of continues, no change to this. Earnings pictures coming in pretty good for the quarter, so we're not too concerned there. Consensus going forward is improving. So when we take the lens back, we have to always look at how we are positioned, what's happening in the market, and is anything changing? I think most people know we're trying to be tactical about this and pick our spots. When we look from a breadth perspective, where is breadth improving and where is it weakening? Well, certainly, we did have an impact on our breadth models in this past week. So what do we say? When the percent of stocks participating in a market is expanding, it's healthy. And when the number of stocks in an uptrend deteriorates, it causes us to take a pause. What does that mean? Well, it means we go back and we tighten up our stop losses. And we stop putting on new positions. And then we watch our eggs in the basket very closely. Should they breach our stop loss levels, and the stop loss levels are placed where it appears that the trend is changing, the price trend for our securities is changing, we are prepared to step away. Last Friday, we came out of Amazon. About 10 days ago, we came out of Qualcomm. We came out of close to half our NVIDIA position. We've come out of some basic materials positions. We came out of a couple of industrial positions. But the breadth model went from being generally positive to weaker this week. Now, obviously, a big volatile couple of days has an impact, and we aren't going to ignore it. We take it seriously. So let's look under the covers at the leadership themes to see what's happened. Now, our number one sector theme has been financials. Given the fact that we went from a world of falling rates to rising rates, we went from a world of where the borrower was in control to a world where the lender's in control, and of course, financial services fit that bill. We only just broke out of a very long bear market. This is a sector that is underowned. When the market started to believe that there could be cuts going forward, we saw the stocks blast off, and we've pulled back part of last month's gain, about 5%. So the sector held up just fine. In fact, if we looked at the insurance companies, down about 4% off the highs. The investment banks, which include the capital markets banks like JP Morgan and Morgan Stanley, These are highly sensitive to the health of capital markets, down about 5%. So remember, NASDAQ, top to bottom, NASDAQ 100, 19%. So I always want to know what relatively holds up better and what is relatively weaker. We also want to see what bounces when you get some strength and what doesn't bounce. Industrials, they only just broke out of a consolidation range. They pulled back and quickly got back above their consolidation range, down 4% from the highs. Very resilient. And this is a sector that you would expect to get hurt if we think that there's a recession coming. So if you're in the camp that thinks this weakness happened because we had some weak economic data, this would belie that fact. If we look at aerospace and defense, which has been a big sector for us, down 4.4%. When we look at the materials sector, highly economically sensitive, down 5.3%, and trading above the most recent consolidation range. I think that's pretty positive. Certainly, when we look at the shares of the home builders and construction supply, down 5.9. Again, another highly economically sensitive group. We've given up about 1/3 of last month's gains. Now, the XLK is the large cap tech ETF, off about 17.5% top to bottom. It's regained some of that today, up 2.5%. That's positive. But we are below some important moving averages, and we have had relative strength versus the S&P come down. Now, the XLK, which is made up of 22% Microsoft, 20% Nvidia, 4.5% Apple, 4% Broadcom, is now trading better than only 63% of the stocks in the S&P over the last 52 weeks. So this is a change, right? For sure, this is a change. Weaker relative strength. There certainly has been some selling. If there's more unwinding to do, likely we will see some more here. We have seen a lot of the earnings from these companies come already. So it's not like we're waiting on a lot more information. Nvidia is not till the end of the month, but there is information in the marketplace, and they should be back in the buybacks. Now, we highlighted that the breadth or the percentage of stocks in the NASDAQ 100 in uptrends in the beginning of the year was at 86%. So 86 out of 100 were in long-term uptrends. As of the beginning of July, 62% were in uptrends. As of last week, we were at 44%. And as of this week, we're at 36%. So when one by one stocks are breaking down, that causes us to be very cautious. And as you know, we've carried just about a 1/3 weight of the S&P and tech over the last couple of months because this was taking place. We highlighted that the semiconductor sector, this is the SOXX ETF, which is made up of the broad base of semiconductors, over time has become stretched a long way away from the 200-week moving average several times. It got 82% above the 200-week moving average and then corrected 26% over about 6 months before it was able to get going again. Then in 2020, it was 70% above the 200-week, had to correct 37% over the next 3 months before it was able to get going again. Got to 100% above the 200-week in 2022, pulled back 49% to the 200-week moving average. So these were both price corrections. And recently, we got to 78% above the 200-week moving average, and we got that weekly reversal we talked about. So it's now down 17% off the highs. I don't know whether that's it, whether there's more to go. All I know is breadth has generally been weak. Sorry, this was as of last week. This is as of this week, down 28% off the highs. We're now down through the 50-week moving average. My guess is there could be some additional room to run for semiconductors to the downside. So I believe AI is going to be an important source of economic activity in the future. I also think the market has priced a lot in. And we're going to have, a lot more positive news, I think, to get this group going. So we'll see. But there is some pause for us adding exposure here. And the breadth model for semiconductors went from 60% of stocks in uptrends all the way down to 12%. So the one positive thing that I can say is that when it has got down towards 10%, it has often been close to a near-term low. So we'll see. But we can't add anything in this group while breadth is deteriorating. We can watch and see what holds up better, what bounces better on a strong day, and build our farm team. But at this point, this is a group that we're being a little bit cautious on. Let's talk energy. Energy is off a little bit more. We've talked about the fact that it has been correcting. It's off about 12% from the highs. This includes all energy companies. The large cap dividend payers, like Imperial Oil, for instance, have been highly resilient. We talked last week about the fact that they're raising their dividend and buying back, an absolute ton of shares, and the cash flow being generated by these companies is very substantial. So base case stays the same here. This is the utility sector. We highlighted over the last few weeks that it had started to behave better over the last few months. We do have a couple of positions here, NextEra and Southern Company. It only sold off 3% over the course of the sell-off. So feeling pretty good about that. It only just started to relatively outperform the sector. This would highlight the fact that I think investors believe that rates are likely to be more benign and be more friendly. Highly defensive sector like real estate acting a little bit better. This is the ICF ETF, which is made up of a broad base of real estate investment trusts, and it's trading basically at the highs. REZ, which is residential apartment REIT, is trading at the highs. So these are the two newest adds that we made in our portfolios over the last couple of months. So what does it all mean? Well, for financials, we actually have a little more now than we did a month ago, and it's by far our largest weight. We think the group looks resilient. We think that they benefit in this world that we're in, where we're seeing good dividend growth and strong performance in capital markets. Industrials are an important weight at 11.5%. Some of that's defense, some of it's machinery, but we've come through the earnings period with great numbers. Technology, of course, is a significant underweight at 10%. This was a more significant weight, but has come down over the last few months, and probably for good reason. Energy came down 3% over the last month in weight. You can see that we have trimmed a little bit here, and we trimmed a little bit in materials, partly because copper has acted a little bit more sloppy, and some of the economic data, points to the fact that maybe we want to be a little bit more cautious. So cash is just about 6%. It's not a lot, but it's more than where we were a month ago. We're going to keep managing our positions one by one. We do have a very low weight in consumer discretionary because we do think that is one area of the market that can get negatively impacted by these rates. And we are seeing some very weak performance in stocks like McDonald's and Nike and Lululemon. So what are we watching? We'll watch breadth. We're going to watch the market's ability to rally off the lows from yesterday. My guess is we'll maybe retest those. We have seen a pickup in volatility. It's important to watch that. When you've had these big spikes, it doesn't tend to go on for a long period of time. It tends to moderate. So we'll see. We have come down a long way off the highs from yesterday morning, but we are not yet back down into the range where we would say volatility is benign. You have to remember that we are into a liquidity cycle. The number one thing that we know is that liquidity is what drives prices. When you have a fast move in a currency pair or a fast move in yields, that always upsets the apple cart because somebody's on the wrong side. So that's playing through the market right now. I think we're on the right side. I think our sector weights are good. Sector exposures are behaving well. We're trying to manage our positions position by position. We've got a little bit of cash for some flexibility, and we'll watch markets as they go forward. S&P's off 4% off the highs. We don't like to see it come off, but that's not a big deal. We're only just into a new cyclical bull market. And we are running up to an election, and there's things to talk about. So we're going to watch the individual themes. But at this point, we feel pretty good about the portfolios, and we're going to take this day by day. If things get worse, we'll raise more cash. But at this point, we're pretty happy with the way that things are coming through earnings. And in fact, our companies beat estimates quite handily over the course of the earnings period. So with that, I'm going to answer questions. I encourage you, if you're interested in between these meetings, to follow us on Twitter. At Barometer CA is my handle. I put up 4, 5, 6, 7 things a day. And we post any of the BNN spots that we do there. We want to make sure we're keeping people up on what's going on. And certainly, people can give us a call and ask questions if they like. Let me just see if I've got anything here in the questions and answers. See if I can pull that up. Here we go. So the question, first question from an anonymous attendee: in 2020, U.S. total debt was 23 trillion, and it now is 35 trillion due to funding 2 wars that have no end in strategy. So is the fear of war directly involving the U.S. and Lebanon not the reason for the U.S. Treasury bond falling from 4.8 to 3.8, where the bond market is forecasting a 1970s type recession? Yeah, I don't think that that's the case. Certainly, yields have pulled back. If you remember, in the 1970s, it was because inflation was rampant, and we had double-digit interest rates, and so quite different. We are not big holders of U.S. Treasury bonds. We think that other types of assets can benefit from lower rates. And that in general, rates are going to ratchet higher over the next several years in a series of cyclical advances and declines. So no, we don't think that the market's forecasting is 1970s type recession. If it was, I think we would be seeing some of the sectors like the industrial sector, some of the capital markets banks get smashed. And that's just not the case as it is right now. From my friend Alejandro, good afternoon. Do you think silver will still outperform gold if the precious metals continue within a new bull market? I do. I think that the setup for both gold and silver looks very, very attractive. I think that private investors and institutions really have not been participating. I think it's largely been central banks as buyers. I think that they are relatively insensitive to price. They are looking for alternatives to hold outside of treasury bonds. Because we know that government debt is going up quite dramatically, and it doesn't really compensate us against inflation. So the fact that gold is hanging in like it is, I think is pretty bullish. And then the next question was, why do you think Warren Buffett sold Bank of America? I have no idea. When it comes to Warren Buffett, he makes his decisions for lots of different reasons. I do think it's very interesting that he sold a yen-denominated bond yesterday specifically to buy Japanese equities. And I think it's interesting that he has been a buyer of Japanese equities now for over a year, and has made pretty significant commitment there. But I do not know why he sold Bank of America. Are there any more questions? I don't see any more. Okay. Listen, I want to thank everybody for joining us. If you're feeling shy and you don't feel like asking directly, please, reach out. Oh, I got a couple more. Okay. With the markets looking forward 1 year, how does the market fare the year after a U.S. election, and does it vary if the incumbent wins or not? It tends to be that the first year of a after a new election is positive. I think it will depend what works depending on who gets elected. I think part of the strength in small and mid-cap stocks has come from the fact that it appears, or it has appeared, that Trump has an improved possibility of being elected, and we might not like his social views, but he has made it a priority to work at cutting regulation, and that would certainly help small and mid-sized businesses. Steve asked a question about, could a Chinese economy impact commodity prices? I'm going to say that there isn't probably anybody on the planet that doesn't know that the Chinese economy has been having difficulty. They are definitely not developing as many infrastructure projects as they have been, and real estate is weaker. That certainly could have an impact. It surprises me, frankly, that commodities have held in as well as they have, despite the weakness in the Chinese economy. And I think part of that is that there are a lot of investors interested in owning hard assets in a world where, there certainly is some inflation. Opinion on the Canadian dollar FX setup. I'm frankly surprised at how well the Canadian dollar has held in. Given what's been going on in the Canadian economy and rates, we're an early country to cut. I might have expected the Canadian dollar to back off. On the other hand, if you're relatively bullish on commodities, that should be a supporting factor for the Canadian dollar. Surprisingly, the Australian dollar broke out versus the US dollar higher, and they are highly exposed to China. And the Canadian dollar and the Australian dollar often move together. So I think that that's interesting also. It may be that we get a surprise. The Canadian dollar is more resilient than we would think. We are currently hedging our pools back to Canadian dollars because I do think there's a risk Canadian dollar can go higher, which would surprise a few folks. I'm just trying to see if there's anything else here. Lawrence Knight. Oh, if silver and gold are attractive, would you buy the miners and or bullion? Well, we do own both miners and bullion. And I always preface that by saying we're not gold bugs, but the technical setup is good and it fits with the macro themes. So when you saw the big miners report their earnings over the last 2 weeks, the cash flow numbers that they came with were well ahead of expectation. And I think expectations are very low because it's been a long time since people made money in these companies. So higher prices are having a positive impact on the companies and their ability to pay down debt and return capital to shareholders, I think is pretty substantial. Now, I think that's all of the questions. Anyway, thank you everybody for joining us. It's 4:51. I'm sorry I've been a little bit over my time limit today. But please don't hesitate to reach out and ask us questions if you've got additional ones. And otherwise, we hope to see you again next week. And we'll see what's happened between now and then. Have a great week. Thanks, Diana.